Ladies and gentlemen, if you would please join me in welcoming back to the stage Donald Broughton and Morgan Brennan, our moderators, as well as David Parker, Derek Leathers, excuse me, and Richard Stocking as our panelists to start our next session on economic demand. I was talking to Donald last night, who said we can go for 3 hours on economic demand, and I said, well, we've got an hour and 10 minutes, so we're going to be quite busy. So let's go ahead and get them back on the stage, and we'll go ahead and get started.
Does yours go straight back too?
Yeah.
It's horrible.
I know.
All right.
Hear me talking.
I think we're on.
Come on back in. Come on back in. Seats up front.
When you coming to fix?
Well, I want to welcome everyone back. We intend to spend the next half of this talking about what's happening overall in the industry, both from a capacity perspective as well as a demand perspective. We're very interested in talking with each of you about the economy, what you're seeing from a demand for trucking services perspective. And we know that over the last 40 plus years, we've seen truck tonnage consistently with a lead time of 2 to 5 quarters predict every single recession and every single recovery. And I think we actually have a graphic here maybe that represents it, if it's possible, if it works. So again and again and again, you've been the leading indicator, telling us whether or not the economy was expanding or contracting, and if so, why not, what for, what was going on. And so we're very, very, very tuned into what you are seeing and why.
Which brings us to our first question. So the American Trucking Associations reported that after growing at a pace of almost 4% last year, the rate of truck tonnage growth has slowed a little bit this year. It's just under 3.5% through the first half of 2015 and closer to 2% in recent months. Yet, we saw the government raise GDP estimates for the second quarter, 3.7% growth. What's going on here?
Well, you know, to me, when it comes to truck tonnage, I think that the phenomena of fracking has been such a major phenomenon for the last X amount of years, and I think that there's been an invert of truckload volumes that we keep up with versus truck tonnage that we keep up with. Because when you think about one of the whales, there is a tremendous amount of heavy water, heavy sand that goes into those whales, and I think that is the vast majority of what has happened in the last couple of years and why those numbers have became, to be honest with you, I'm not even looking at, personally, I don't even look at truck tonnage anymore. I stopped probably about a year and a half ago from that. I mean, I glance at it and look at it, but it's not a leading indicator for me. Mine is much more GDP and industrial production.
What is a leading indicator?
For us, what I look at is going to be GDP. It's going to be industrial production, which I rank industrial production more ahead than I do GDP, because to me, industrial production is what we actually truly haul that goes in these trucks. So I look at those. I look at ISM, that Institute of Supply Management. I think that's a great tool. I've watched that for probably 15 years religiously, and whatever you use, 99% of the time, whatever comes out with that ISM is the way in which I feel. And I say, yeah, I agree with this, because anything under the number 50 is, quote, recessionary, and anything over 50 is positive. And what we have found in our business is that we start feeling a negative or a slowdown in the economy when ISM is below about a 46 or below. We start feeling it. But when it's in that 47, 48, we're still feeling pretty good about business.
Richard, what are you seeing?
Yeah, I think overall, I think customers are still concerned about capacity going into fourth quarter. We're seeing that customers really want strong partnerships that last through the thick and the thin. I would tell you that it's not 2014, but we're not jumping off a cliff either, as some may suggest. So I would say it's steady, and I think, I was with 6 or 7 customers in the Midwest and the East Coast recently, and all but one of them were pretty excited about Q4 and the possible volumes out there. So I think they want partnerships. I think there's also a flight to quality for the drivers and the customers. So the customers are looking for core carriers that can get it done, that can innovate, that can really optimize their network, present solutions to them to reduce empty miles, to do this, that, and the other. And so I think we're seeing some of that flight to quality as well that brings freight into us. Our EDI rejects, throughout the year have been escalated at times and kind of dipped down at times. July was one of those. August is starting to come back up. So, I think we're going to see a fairly good fourth quarter, and it's steady. It's not doomsday, is what I would say.
Yeah, I mean, not a ton to add. I mean, really, but as ironic as it may sound when we say we're not looking at truck tonnage, or we're not looking at it as much as the analysts are, we all look at it. But at the end of the day, if the economy's slowing, I don't just allow the sales force to say, well, the economy's slowing, so we'll just have some bad results until the economy comes back. We have to innovate, and we have to get customers to come to us and take more than our share. And so we're going to fight through that. But to Richard's comment, 14 was an anomaly. I mean, 14 was a very, very erratic year. It wasn't just that it was strong demand, it was extremely erratic demand. You had the big storms in the first quarter. You had intermodal disruptions that lasted throughout the year as they tried to dig out of the effect of the storms. You had a lot of fits and starts in the economy and in the freight economy all year long. And it led to robust pricing. It led to a flight to quality. It led to opportunities to price and secure business out in front of your, with a further lead time than ever before, or not ever, but than we'd seen in a while. 15's a more of a normal, strong year, and it's stronger than 5 of the preceding 6 years if you take 14 out of the equation. So we feel good about where we're at. Clearly, GDP used to be an indicator to say if it was GDP was at 3, you might see tonnage growth of 6. But our economy's changed. We have way more service components in our economy and way less production. We have way more government spending going on and government being part of the economy overall than we've had in preceding years. And that stuff doesn't go in trailers. And so industrial production does, retail goods do, but as a larger and larger percentage of retail goods are imported, we move them once now, where we used to move the raw material to the plant, from the plant to the DC, and from the DC to the store. When you import it from China, we move it perhaps twice, port to DC, DC to store, but often it's store direct. So it's just less movement of the same amount of goods because more movement's happening overseas, just like more production. So we got to kind of work our way through that. But in our business, retail is a big part of what we do. We're 47% retail. The predominance of that is in the discount retailers, and they're doing pretty well. I mean, their same-store sales are up year over year. They're growing. They're taking share. And we have yet to see, in my view at least, the consumers spend the money that's come to them via the fuel dividend. I mean, as fuel dropped, consumers have $1,000 to $1,500 more in their pocket year over year, and they're really not spending it. They're paying off debt, they're saving it, they're doing other things. That will change, I think, as we go forward. You'll start to see people opening up the wallets as we go into the latter part of the third quarter and into the fourth. And also, as Richard said, we talk to our customers. At the end of the day, regardless of what's happening in the economy overall, if I've got my customer base and they're rolling, that's good for me. Richard's customer base may be different, and if they're struggling, that's a different situation. So we are constantly battling not only for new customers, but the right ones. And we want to hitch our wagons to customers that are having success.
And I really feel like we're at equilibrium, right? And any uptick in GDP just sucks the capacity out of the industry, and that's why we have a little bit of volatility right now. And to Derek's point, just think of the products we buy. These phones and how thin these phones are, and the TVs are as thin or thinner than these things, right? And it used to be 3 feet for a TV. And you think about all the packaging and improvements and the water taken out of the detergent and all those types of things. And I think also, Derek, I don't know if you guys agree, but I think the consumer is spending a little bit of that money, but I think they're spending more on healthcare. I think they're spending some on education. They're for the digital craze. So a lot of those things that we're spending money on don't really create loads.
Yep, that's a good point.
As well. So I think that's just a little bit to add to what Derek said, but I agree 100% with where you're going.
And to your earlier point, you can bemoan them shipping full containers straight to direct to store, but I know you in particular have gone from being a trucking company to being a transportation company. I know a couple of your discount retail customers were taught that trick by you.
Yeah, I mean we really believe that at the end of the day, freight will find its most efficient path. So we can sit down idly and sit on the sideline and protect our lanes and protect our freight, or we can engage our customers to try to make their networks more efficient. And if we don't engage them, somebody else will, and that freight will end up moving on some other color other than blue.
Right.
And as long as I'm around, as long as our management team's in place and our leadership, we believe we have to be mode neutral. We have to sell our customer the best opportunity for them, and they will come and repay that with additional freight in the future. And that's going to stay our strategy and our mantra and our culture.
And ours as well. I think it's you turn into a solutions company, and you're no longer a trucking company. You're providing those solutions, whether it's over the road, on the train, dedicated, whatever it is. You're actually providing the solution for that customer. That really deepens your relationship and elongates it.
Yeah, well, and we saw you do that at Covenant. 2 years ago, UPS had horrific service issues. This last year, they didn't. Tell us about what you did for UPS.
You know, we're probably one of the largest peak carriers in the country in the fourth quarter. I mean, it's because of our team drivers that we have, and there is no doubt that in 2013 it was a bloodbath for, you know, UPS and FedEx and a lot of them. And last year was a lot of difference. Now, that said, I agree with UPS on their statements that they made on their own conference calls for 2014, is that they went above and beyond what they should have done. And this year, I think they'll pull it back somewhat to some normal number. But I mean, you know, they built tremendous amount of sorting centers, added about 3 of them here in Dallas, Texas was one of those. But they took a group of trucks and on guaranteed capacity that had no idea what those trucks were going to do. Right. But the thing that we could see, and the thing that we've worked with them on this year, is that during the quarter, matter of fact, halfway through peak last year, we got up and said, listen, you're not utilizing all these trucks that you're paying a daily basis for, even in your own network, you're not utilizing them, because we're sitting over here on freight that we guaranteed you that we're going to pick up, and you don't know it, but we're struggling to get it, you know, over here on the time frame that you want us to. And here are the guaranteed trucks that you're not even utilizing. Let us take these guaranteed trucks and run them up here and get it. Those are the kind of things that are going to be happening this year. Last year was too critical, and again, I could say ditto for FedEx and a lot of the air freight companies. UPS just kind of took the, you know, they're the big mama that has to get all the heat and all the glory. But so that's what we did for them last year. But it was a great success from our standpoint, but it wasn't as much for them.
Yeah. Well, you know, Morgan and I have been going back and forth talking about, you know, the concerns. We've seen these wild gyrations of the market. The market is obviously concerned that something's going on, but that's nefarious. But that doesn't look nefarious. That looks like an economy that's still growing. Yeah. Is there particular segments you want to walk us through that you're seeing continued growth, and others that not so much? Is there a way for you to divide it from your perspective?
You know, from our style, starting and then going down, but from our standpoint, e-commerce has been exploding. We all know that. Everybody knows that. And it's been exploding out there, and I don't know where the end is in sight for e-commerce. And everybody, I mean, Amazon started it, and everybody is trying their best to catch up or get a piece of the pie of that. And every customer in the country is having an active e-commerce session that is there, but we have seen it continue to go extremely well. We've also seen our expedited piece of our business, and whether that is air freight, LTL companies, you know, those kind of folks that are consolidators, anybody that's consolidating freight, that's trying to take it off of airplanes and putting it in a truck, and it takes, if it's a long distance, and keep in mind, long distance today is anything over 500 miles. I mean, we're not talking, so when I say long distance, don't think I'm talking 2,000 miles of Atlanta to Los Angeles. I'm not. I'm talking Chattanooga, Tennessee to Chicago. That cannot, with the new hours of service rules that were implemented in July 2013, you can't do that. That is requiring a team operation today to run that. So the expedited is going great. The organic food is going well as everybody in this room becomes 120-pound kind of men and women in here, or 100-pound women, 120-pound men.
You got a problem, brother.
I got a long way to go.
You got a long ways to go. but you know, most of us are eating proper or better and all that kind of stuff. So it goes hand in hand with the organic side of our business. Also, I've seen really the things that you read the headlines about as it relates to our business would be automotive has been very strong. I'm very happy with what I've seen for the last 2 years on our auto sector business. Housing has been very strong. You know, the carpet industry down in my hometown there in Dalton, Georgia, has been extremely strong. So automotive, housing, those kind of things have led the way for us.
Yeah, we would echo a lot of that. I mean, discount retail, as the competition in that space has continued to heat up, we've seen positive growth in same-store sales I talked about earlier. Mexico is a place that's growing as a geography. I mean, the amount of freight coming into and out of Mexico continues to grow. We have a very large franchise down in Mexico. It's a big part of what we do every day. And that's a very fast-growing portion of our business. It's difficult to do, but if you have the right processes in place, it's something that's we're very bullish on that as we look forward. The home improvement business is something that's kind of not talked about as much, but you look at folks coming out of the recession and wanting to put money back into their homes, and not maybe as quick to jump into a bigger home or flip into a new home, but rather that embedded debt of not having taken care of the home they were in during the recession. We're seeing that business do very, very well. So those are some of the things that we're putting our eye toward and focusing on and seeing in our business that's going well. The e-commerce clearly is here to stay, and that's an ever-evolving story in terms of how each customer attacks that market, and they all do it in different ways, but it certainly changes our networks a great deal year to year as that space continues to grow by strong double-digit numbers and often, you know, much higher than that.
So I really need to just echo what they're saying. I'll tell you that automotive replacement parts are huge. I'm with Derek. Mexico is, in our opinion, on fire. You have a lot of nearshoring, more manufacturing coming back to Mexico. Assembly of product, where we're hauling the raw product down, they're assembling it, we're hauling it back up to the U.S. and goes through the network that Derek talked about earlier. Consumer products, food and beverage, is all doing well. The discount retail, again, I would also say that's on fire as well. But check out this e-commerce. This thing is really starting to go. There was a company that was checking up on another organization, and they were in New York City. And so they ordered 24 bottles of water, a pad of paper, and some paper clips. They were at the Hilton downtown. They ordered at 6 o'clock, and they got the product delivered to them by a guy riding a bicycle wearing a backpack at 6:20. And a lot of these folks are trying to deliver whatever we order, like we buy pizza, within the hour that will be delivered. So over time, it's going to continue to morph and change. But more and more people, like you said, David, are copying or getting involved in it, and the expedited, the teams, the shuttles, all have a great opportunity to grow and progress and become more profitable as time goes on, we believe.
Wow.
I tell you another that we've seen some, I mean, we don't compare to y'all, and I'm sure y'all have seen the same thing, but you know, the dedicated opportunities. I mean, we're winning some and we don't win them all, but we're winning some, but there's a lot more coming to the table from a dedicated opportunity than I have seen. And
you got to be careful there. We run over 5,000 trucks in the dedicated model, and sometimes it's a capacity grab, and sometimes it's true dedicated. So yes, yeah, we've been a little bit more picky about what we actually will do there.
Yeah.
All right, two things I want to talk to you about. And the first is, well, we want to talk about fuel and the effects that's having on the consumer and some of the freight that you're moving around. But before we get to that, I know two of you talked about the opportunities in Mexico, and that makes me wonder about the stronger dollar. And if the Fed begins to raise rates and we see that dollar, which has already strengthened pretty dramatically over the past year, what that means moving forward, what it means in terms of opportunities for freight coming from Mexico, but also what it means in terms of something else you were talking about before, which is this idea of seeing stuff coming in from China and just having one trip with a truck. So is it a tailwind or a headwind?
So the dollar is obviously, as the dollar continues to strengthen, we're seeing our ability to buy products overseas or from Mexico continue to increase. The fundamental problem in this business is when we need trailers to go load that product, whether it's at the port or in the interior of Mexico, and we're seeing the corresponding southbound volumes dry up. Now, the automotive business does there's a lot of parts going in. That you manufacture it into cars and things, and it comes out. Durable goods, same thing. But the southbound flows are going to be the big obstacle for any transportation company doing business in Mexico. Where do you find that next layer of southbound? Look on the temperature control side, and with all the water constraints in California, we are seeing a tremendous boom in produce in Mexico. So you have a much, much stronger export volume of produce, and it's only going to get higher as they continue to clamp down on water resources in California. And yet, how do you get enough trailers into Mexico to be able to serve that market? So yeah, I think you'll see an evolution in northbound pricing that has to better support empty moves at times or longer deadhead moves into Mexico. Similarly, if the dollar stays as strong as it is, our export volumes, which are obviously at a significant imbalance to begin with compared to imports, but that gap could widen, and we're going to all have to collectively get creative on how you still ultimately solve that problem for your customer, because they don't really care much about the dollar strength or the economy or anything else. They care about getting their freight moved and getting it there on time, and they want an answer for that. And so we're working all the time to try to come up with a solution.
I'd agree with Derek, and especially at California produce. I think it's moved to Texas, West Texas,
Yep.
and into to Mexico. But when you have an exchange rate of 16.5 to 17 pesos for the dollar, it's going to create some issues, some imbalance issues, as Derek talked about. And that's the trick. How do we figure out how to produce more southbound? Because for every southbound, there's a lot of freight coming north. And the ports down in Mexico have really increased. I think it's really, this whole northbound has really put a lot of pressure on our team to make sure that we keep in balance, because you can get out of balance very, very quickly, which then adds a lot of cost to your operations. And the same's true in Canada, right? On the flip side, we have the same issue up there.
That's right.
Well, speaking of ports, that makes the perfect segue. We've seen the Panama Canal recently announced that they are lowering the draft. So we're going to see capacity going through the canal drop by 14, 15, 18%. Translate that into what that looks like for freight flows, container flows coming into the U.S. over the next several months. What do you expect to have happen?
We expect it to have a very positive effect on containers coming into Los Angeles, Port of LA, and Long Beach. You know, it's interesting. We were sitting there in February last year saying, okay, the contract is signed, and expecting unbelievable amount of freight coming into the Port of LA, and it just did not happen. And come to find out, you know, our customers had moved about 40% of their imports to the East Coast. You know, now that said, the East Coast for the last couple of years, I'd say for the vast majority of us, it's been a pretty good outbound area. We've gotten a lot of freight and strong freight that used to be a weak area that has now became a strong area off the East Coast. Out of Savannah has been unbelievable. Charleston, not as much for us, but Savannah and the East Coast, Chesapeake, unbelievable. And so California, though, took a back seat to that. And what is happening now with the Panama Canal, though, and the big ships can't go through there. Is what it basically is going to boil down to, is that LA will probably become a bigger player until that is rectified. And then the question is, has the customer really made a decision that says, I will never, ever, ever allow what happened in California on the strike to affect my supply chain the way it did? And they probably have to a certain extent. I don't know that it's, you know, the numbers I was hearing from a lot of our retail customers was the number 40%. I don't know if that becomes the norm, or does it go back to 20%. There's still a lot of business out of California, but has not been up until now. It has not been the go area that it has been. That said, I expect the fourth quarter to be unbelievable times because of what's happening on the Panama Canal out of Los Angeles, which was what we want.
It'll be interesting. I mean, because customers have gotten singed, and they're tired of that issue. And so they're paying more to ship it to the east. And I've heard some pretty strong comments that we'll never go back. Now, will that hold up? Maybe not in its entirety, but you're seeing the volumes now on the East Coast, and yes, the big ships won't be able to go through, at least right now. Right. The port of Charleston, I mean, they've dredged to 52 feet. They're ready to take that on, and really we need it to, because Savannah's so tied up. But I still think there's going to be a lot of product, a lot of freight that goes to the east, but definitely we feel like LA could change with this new issue. So
How long?
you might have a little bit of both going on to where it could equalize some.
Yeah, I think the canal issue is nothing short of a disaster for the canal itself and for the East Coast
Mercy.
ports as it relates to the fact that so many shippers had finally kind of had the resolve, as Richard said, to diversify their imports, to say they were going to stick to their knitting on that, and they were going to really ride that out long term. And then right around the corner, almost immediately thereafter, we have a new problem, a new issue that gives them the ability, the out, the whatever you may want to go back to the West Coast, and we're going to be potentially more imbalanced again. But it bodes well for us, as David mentioned. It's West Coast freight. It's going to be good for trucking, good for intermodal, for the Western rails, obviously. And whether it sticks there long term, I think is too early to tell.
And you mentioned intermodal, and I think that's probably the perfect segue into that topic. And that's the fact that we have seen fuel prices come off. I think they're about a third lower than they were a year ago. And what we've seen between that and some of the service issues tied up with the railroads over the past year is we've seen less conversion of freight to intermodal, less stuff going on tracks, more stuff going on the roads with trucks. Is that the fact? Is that actually what's happening for you guys with your companies? Have you seen more freight that otherwise would have converted to intermodal?
Yeah, I mean, I think a lot of customers learned some lessons last year relative to intermodal. We're a big supporter of intermodal. It's a growing part of our franchise. It's going to continue to grow. We're committed to finding those opportunities to convert freight where it makes sense. But with all that said, the storms proved a very valuable lesson last year, which was the disruptions that took place post-storms for the railroads took multiple months and really still haven't completely concluded as it relates to digging out of that and getting back to normalized service levels. So if your product's less expensive, but your service is reliable, customers will go that direction, even if it means longer lead times and greater inventory costs. If your product doesn't get there or gets there inconsistently, it's hard to put a price on that. So freight migrated back. It made it easier to migrate some of that freight back because fuel is low. Now the question is, how sticky is that reverse migration from rail back to truck going to be longer term? Rail is still growing. It's just growing at a slower rate. Truck's growing at a faster rate, both through the combined effect of incremental freight that goes on truck versus rail, lower diesel prices, and that sort of service lesson that was taught through the storms of last year. And I think that's going to stay that way for a while until you start to see fuel spike up and budgets start to bloat, and then they're going to chase savings, and their risk tolerance will be greater than it is right now.
You know, I agree with what Derek's saying. Our business, our rail business is growing at a very good clip, and we think it will continue to grow. I think you've well documented the port issues, the service-related issues that happened, which were very, very terrible. The fuel costs. Folks don't want out of stocks, don't want empty shelves, and so that finished product needs to get there quickly. I think that all kind of stays there, but switching modes is expensive. I think folks want to be consistent, and I think freight will find its most optimal and cost-effective mode. We're all still trying to drive efficiencies within our organizations. Our customers are trying to do the same thing, and so when there's an opportunity and their supply chain allows for it, that you'll still see some of that happen, that conversion and that growth. So we're experiencing that today. Mexico, we're actually teaching our customers that it is okay to use intermodal. Their father or grandfather had a problem with it long time ago when the rails were really, really rough. And it's a training process, and I think we will gain some more share intermodal that way as well. So I agree, but I think we're saying the same thing when both areas will grow.
Let me ask a real quick interjection there. When you say intermodal as it relates to Mexico, are you talking about from Mexico to the border or from the border to?
No, I'm talking door to door.
Door to door.
Ramp to ramp.
So from Monterey.
From Monterey to Chicago.
Got it.
I mean, it goes back to that trust thing that was brought up earlier. If you can trust that it will get there and there's time in your supply chain,
right?
Folks will look at intermodal. But again, people got singed pretty hard with that service disruption, the port disruptions, and they're a little bit leery to go back.
Well, let's put this all in context. I want to make sure I understand. So both of you have intermodal contingents, and you're really
Very little.
You're really more the answer, the antithesis of intermodal in the way you run your business. So just for everyone's review, a year ago we had domestic intermodal volumes growing at a 6.5% pace, and long haul trucking volumes overall were still down 10%. We've had a complete role reversal of that. So we've now looking at domestic intermodal volumes are up maybe 2% at best, and you've got and in shorter lengths of haul, the East Coast, we're seeing declines. If you look at the IANA data in the 15 to 20% range. Long haul road volumes are up well over 3% overall. That's all, not just teams. It's all. So you've had a bit of a role reversal. Is that consistent with what you guys are seeing?
Yes.
Well, I'm going to have to ask this follow-up question then, and that's with truckers stealing freight back from railroads, shouldn't demand for trucking be even stronger than it currently is?
Yeah. I need some more.
Can you make that more succinct?
Yes. I do. I think it's, and that's why I say so much about industrial production. I mean, I don't know what July was, but, industrial production has been down 6 or 7 straight months. And I think that's a lot of what we haul. Now, that said, the thing I think you've heard from every one of us up here is that freight's okay. Supply and demand is about equal. And to me, supply and demand, when it's equal, really means today I need 40 loads, and tomorrow my customers need 40 trucks. So supply and demand is about equal out there. And so freight is okay, but it's not 2014. And so I think it has more to do with industrial production, as well as what Derek was saying about what is making up the GDP, as well as, and I think I don't think it takes a lot, but for the last 3 or 4 months, I've seen inventory levels rise. Keep in mind, inventory levels for the last few years have been at historical lows. Since 2008, the customer has gotten religion as it pertains to inventory levels. They have determined finally that paying me $50 more for a load, it was not worth it than having another $2 million worth of inventory. And so they have really said we have got to have low inventories, which has fit wonderfully into our model. But they said we got to have low inventory levels, and that's what they've operated on for so many years. And it's still very historical low, but it's picked up in the last 3 or 4 months. And when it does, it creates a lull. And I believe that as soon as some of the consumers start spending some of that $1,500 or $2,500 a year on gasoline savings, that it would flip. It will not take much. The only thing it's going to take is a little bit, and we're going to feel like 2014 again.
And I think that's what the customers are kind of looking forward to for Q4, and their kind of optimism is that they're expecting the consumer to start spending some of that money.
You're saying the buyers are, at the retail level are anticipating that's going to come, and so they're trying to stock shelves correspondingly.
And a lot of their inventory is in the back of our trailers. Right?
Jeff, you said you had a question?
Yeah, we had a question from the audience. I think this is a follow-up to Morgan's. With the shift from intermodal to over the road, why aren't we seeing more weakness in the overall intermodal volumes reported by railroads and intermodal players such as J.B. Hunt?
Well, intermodal volumes are growing at a significantly slower pace than we've seen in a long, long time. So I would argue that you are seeing weakness in intermodal volumes, especially as compared to years prior. But we do still see the opportunity for freight to convert. So there is some conversion taking place, but albeit at a much, much lower pace than years prior. So I do think you see it in the numbers, and you do see intermodal volumes slowing down some as of late. And I want to go back to the truck question for a second too. The thing I think we often forget is we keep comparing July and August to last year versus the last years. And last year was an anomaly. We were still digging out in July and August of the mess of the first quarter and the disruptive service issues and backlogs of freight. So we had an artificially propped up July and August. If you compare July and August to normal Julys and August, it stands up just fine. And so I think that's just something that's getting a little lost in translation when we talk about, is freight strong or why is it stronger? I think July has always been, or traditionally, not always, traditionally been about as weak as February. So you got February that's kind of bad, you got July that's kind of bad, and then you build out of it going into peak. We last year had 1 year where it wasn't like that because of pent-up demand that was still hanging around from June and May and April and March in some cases. So we somehow believe that's the new normal, and it wasn't. We're back to normal July, normal August, but it's in equilibrium and relatively strong on a year's comparison basis, just not on a year basis. I mean, look, so we feel comfortable with where we're sitting right now.
I would agree. I mean, we look good for when you look at 10, 11, and 12, and 13. But the our intermodal volumes are up over 10%, and we're growing, and it's not the 20% we wanted. To Derek's point, we're a little bit off of that, but it's still growing, and that's why you're not seeing that at Hunt and these others, is that we're growing. It's just not as a fast rate, as fast of a rate.
So to your point earlier, David, you look at this link between retail sales and volume, which I pulled up here on this chart. It seems to be fairly tight, and more recently it's broken. And to what you're saying, Richard, it looks as if retailers are building inventory in anticipation for good holiday shipping.
Right.
Yes.
I mean, we look at our business for, our project business, even the business for the day after Thanksgiving sales and so on and so forth.
Right.
And when we go through all of that, it is as good as even last year.
Yeah.
So we'll see how that all works out, but I think they're anticipating good.
Which, to Derek's point, is an incredibly tough comparison.
Yeah, which is a tough comparison, but we'll see how that plays out, October, November-ish time frame. But again, I think they're expecting and hoping that the consumer will get out there and start spending.
Yeah.
What if they don't?
Then our volumes will be muted.
Yeah.
Yeah. Yeah.
Because that to me seems the most curious thing, is the fact that we have seen fuel prices come off as much as we have. We've seen such strong savings at the gas pump for consumers, and yet we really haven't, as you guys have mentioned earlier in this panel, we really haven't seen that yet trickle out necessarily into the marketplace.
I think it's similar to what, as Derek, because it's the most recent snowstorm was in the spring of 14, and there was such tremendous amount of pent-up demand that when it was released, it took us into 14 for about the rest of the year. It was like May or June of last year for the rest of the year was unbelievable. I think the same thing is not necessarily, I don't want to compare nothing to 2014 because truly it may have been a once in a lifetime deal, but I think there is some pent-up demand on exactly what you just said, is that I sit on the transportation committee of the Atlanta Federal Reserve, and I'm here to tell you that the meetings that we have, the thing that we spend 30 minutes at that they just cannot get their hands around because they don't know, and that is the consumer is saving this much on gasoline, and why aren't they spending it the way that the Fed expected them to spend it? And
well, no, go ahead, sorry.
No, so I do think there's some pent-up demand, and I do think that our customers have increased inventory levels somewhat, expecting, I'm like Richard, I have in the last couple of 3 weeks, I've been to Seattle with Amazon and, the Walmarts of the world, and what they are expecting is they're counting on last year. Now, I hope it happens, but it's some numbers.
And there's customers out there that we cannot keep up with today. And we can't grow fast enough for them. And he mentioned one
you can't.
Of those customers. So there is pent-up demand. I think the consumer, and I don't know this for sure, but I think they're kind of waiting to see. They want to trust that this fuel is going to stay low. They don't want to get caught with, okay, I started doing this and it snaps back.
And that was exactly the point I was going to make. I think the thing about consumer confidence that's unique in my view, and I don't have any data, this is just my thoughts on life, but consumer confidence has never been under more of a direct attack on a daily basis than it is in this economy as compared to previous cycles. We have information at our fingertips more readily available than we've ever had. Something bad happens anywhere in the world and we know about it in minutes. Some possible economic issue in Greece, Europe, Japan, or wherever, and it's on everybody's phone within minutes. So every time you climb out of your foxhole to say, I'm going to get confident and I'm going to start spending, you have more negative information being presented to you than any preceding cycles ever had. And I think people are just more cautious. They're more careful before they spend it.
whatever happens in another country does not affect how much my wife spends at Costco. I tell her she's an outlier. Something's going on. But you're right. The confidence is low, and if it snaps back, I think then they're in trouble again. And they've been to hell and back a few times, right? And so they don't want to go there. And so it's going to take time to trust.
So maybe Greece and what happens in Greece, or even what happens closer to home in Puerto Rico, isn't something that's necessarily affecting what your wife's buying at Costco. But is the stock market? I mean, we've seen several thousand-point swing this week in the Dow. I mean, I would imagine that has a huge effect on consumer confidence. Are you watching that closely?
For sure.
Yes, absolutely, it does. I think it leads. The new nightly newscast on CNBC. I don't know if you've ever watched that or not, but it's a great.
Once in a while.
Heard about it.
But it leads, and I do think that takes consumer confidence to a level that says, this may be paper, but I don't have as much money as I had, and I am going to hold on to it. So there needs to be hopefully a stabilization in the market.
And I still have kids going to college, and I still have to, I mean, you look at housing. Housing's starting to get a little bit better, and I think there's 10, 11 truckloads of freight for every new home that gets built. And so, this confidence could come back, but again, it's going to take a while, we think.
Can I interject a question here from the audience along those same lines? If consumerism is a main driving force for freight, do you believe slowing the growing income stratification is an important issue for transportation companies, even though the two may not seem related?
That sounds like a Princeton answer.
It sounds like a Princeton question.
Wow.
That's it.
Look, do I believe that we need to find a way to do a better job of creating a stronger middle class? Absolutely. Do I believe the way we do that is to legislate our way through that? Not so much. I think we have to have a return to the jobs and things I talked about earlier to make that happen. I think we have to have an opportunity for people who work hard and do an honest day's work to be rewarded for their efforts. I think we have legislation coming down the pipe right now, in my view, that will further increase that stratification, even though it's directly intended to do the opposite. So when you start going out and creating minimum salary wage ranges of $50,440 and mandating at the government level that if somebody's going to be paid salary, they have to be paid this amount, you create an environment where you are going to incentivize people or companies to pay more people by the hour than through salaries. If you say that bonuses don't count as income and we're only going to consider base wages when we make these calculations, then you're expressly taking away incentives for the hardest working, best performing people across this country. And so we have more of this type of legislation coming down every day that has the unintended consequence of furthering the divide, only so we can turn around and point out the very division that's being created by our own actions and blame it on somebody else. So yeah, I've got some feelings toward it beyond just what it means to our freight network and beyond what it means to our company. And I think we have to get back to a place that starts with trust, that starts with believing that people are generally good, that starts to believe in the American people and actually give them a chance to do what they do and do very well, which is outcompete other countries all day long if the government stays out of the way and lets them do it.
Less regulation, more opportunity to differentiate with your people. I agree with what Derek is saying. We've really got to get through this regulation stuff because, again, the trust will help us all speed along the direction we want to go. And you have to have incentives. You have to have opportunities to reward people differently.
And to say that we've had market oscillations is an understatement.
Yeah.
It's been more like a bungee jump.
Right.
Just, and then back and away we go.
So we haven't talked really about these EOBRs coming.
I was going to say that was the perfect lead into with your regulation question reference, yours as well. That's where we should go. What we were going to talk about at the end of the previous session, but now's the perfect time.
Well,
we're having this increased regulation. We can agree that the consumers should wake up at some point between now and Thanksgiving. Is that where we are on the consensus?
Yeah. After Labor Day.
Okay. Now, the consensus is that at the end of September, the Federal Motor Carrier Safety Administration is going to put in some type of mandate. They're going to, that you will have to have an electronic logging device, an EOBR, in the truck at some point within the next 2 years, which you all have. Your company pioneered back in 97, 98.
Correct.
Tell us about what you think that regulation is going to do from a capacity perspective to start with.
Yeah, capacity, I mean, it's going to have a big deal to do with capacity. I mean, just think about this. You've got us three that have this 100% in our fleets.
Right.
We can run a certain amount of miles every day. You have brand X who doesn't have it in their fleets, and I call it cheap illegal capacity, and maybe I'm being a little bit too snotty about that, but they can run maybe 100 more miles a day. Now, when this regulation happens and they have to change,
Which is 15 to 20% more capacity.
It's quite a bit.
Yeah.
And when they can't do that, and they, you know, they're not in way good health. They're kind of living paycheck to paycheck now. Their fleet is older. The maintenance costs are high. Banks aren't way excited about lending them money. And now all of a sudden they have to run that 100 miles, 50 miles less. How are they going to make it? I think we're already seeing the phenomenon of the drivers coming into our fleets because they know we match that up with our load optimization software where we maximize the driver's hours. We're working really hard to improve that productivity, which turns into W-2 for the drivers. I think you're already seeing that. And I think the customers are all now starting to say, okay, maybe this person or this fleet is the fleet to go. Maybe this should be my core carrier and not this person that may be running hot or running illegal. Honestly, I think it's going to be a game changer for capacity in the country.
Yeah, we think the same thing. I mean, you know, we know that 07, 08, and Donald, you really lead this effort, but, you know, whether it's 10 or 20% of capacity that left, I mean, it was a big number. 300,000 or 400,000 trucks that left in that 07, 08 kind of time frame, and the ones that survived it, the ones of us that were able to get through that, we reaped the benefits since then because of reduction of capacity. That's the only blessing, to be honest with you, about the lack of drivers is that it does keep a lid on capacity if any of us want to do something stupid. And so it does do that. But you're exactly right. When the onboard computers come on board, and I think it is over the next 2 years. Somebody asked me just a little while ago at break, you know, he said, last time I talked to you, you were 95%. And I said, well, today I'm 99%. And the only reason why I'm not 100% is because the government is involved in telling us when the date's going to be. But because it is law already, it's already been passed. So we got a law that it has to happen. It's just a matter of when. But you know, the American Trucking Association will tell you that we believe that September 30th that we will have the details of when it's going to be. So I feel very confident that that's going to happen. And you're exactly right. It is probably, we are throwing out it's 8 to 15% capacity reduction. But whether it's 6%, it's a big number, and it's going to feel effect. And we do think that some of the carriers that are already on onboard computers, that they will reap some benefits of the drivers that will come work for them, because there is a learning curve. It took us about 2 years to learn what we could and could not do, but it is, especially in the single operation, it affects our teams as well, but the single operations is a big effect. You know, a few years ago, before hours of service, I mean, a single run was 500 miles or below. Well, I'm here to tell you today, depending upon what your deadhead is, but the average length of haul is about 350 miles, is about what a single can run.
So you got to tell a story. Derek doesn't know this, but I was a terminal leader in Kansas City 15, 16, whatever years ago, and one of their drivers, Warner's drivers, came to Swift. And we put him through orientation and got him out on a truck, and he immediately left within the first week and went back to Warner. You know, because he wasn't really able to do the paper logs, and he really liked electronic logs, so he went right back to their company. Yeah. And so I think you're right. I don't know if you said it here at breakfast or something, but that's really going to play out with the drivers in the schools. And when you think a company pays 65% of their costs out every week, their fuel, their driver pay, so on and so forth, and if you're not able to run like you used to, if you weren't running correctly, that's where the bankruptcies, that's where the consolidation, that's where the big change may happen.
And all I would add is that I want to be clear that we're not saying that the 60% of carriers that don't have electronic logs are out there knowingly running illegal. It's just a reality of how you can log on paper versus electronically. You can log, miles per hour that weren't actually driven. You can log yourself to places at a different time than you were actually there. And there's no way for the owners of those companies to know exactly how that all works. There are companies that'll push their drivers to do that as well. But if you look at the mix of all of the above, if you take the fleets, the 40% that have converted, they've on average seen a 4 to 6% reduction in their miles. The 60% that haven't converted have not converted for a reason. So there's no reason to believe their reduction will be any less than that. So I think it starts at 6 and goes north from there. So 60% is going to see that type of reduction in a best case scenario, and that's a more meaningful change than the storms from last year that threw the network into total disarray. Right. That's a more meaningful change than the last hours of service change, which locked up capacity in many, many parts of the country. So this thing's real, and you'll see the early adopters or the new wave of early adopters, once this rulemaking comes out, start converting right away. But there will be a group of carriers that won't convert. They'll wait the 2 years, and I think they'll just walk away because conversion will be too difficult or impossible for them based on where their miles are. So this does have teeth. We think it's the right thing to do, because if we don't get on electronic logs and we can't prove to America that every driver's driving legally within the rules of today, they're going to keep changing the rules. So first and foremost, let's prove that we're doing it legally today. Then we can fight about what the right rules ought to be.
To Derek's point, we had a call from a fleet, I think maybe 800-900 trucks, and they had some safety-related concerns, so they were kind of forced to get on electronic logs. And they called and said, "My goodness, I've got 10% less productivity, right. Just because it's different in logging." And so I agree 100%. It's going to be definitely a big change.
Does it have any kind of effect on driver recruitment and retention?
Well, I think it's so for us, once upon a time, when we were doing it early, it was an obstacle to recruitment because drivers thought it was a negative. We now have a decade of data that shows our miles per truck per week at or around the very, very top of the publicly traded truckload group. We've proven that you can do it legally. We've proven you can get a miles. So now it becomes an ease of doing business. It's less work for them, less tedious, less paperwork, less things they don't want to necessarily have to do, and it's done for them. So right now I think it's a positive. I think for anybody with electronic logs in their truck, we're seeing a migration of applicants in the experienced driver pool, because if they see that it's coming, the first thing they're going to do is go to a safe harbor where they know that the company knows how to do it well. Right. So I think it's a positive as we go forward.
And Donald never believes me when I tell him this, but when we put them in, we actually got over time more miles.
Yes.
Because we're able to utilize the driver's hours. They would come to us and say, "Hey, I'm out of hours," and we say, "Okay," but now we know that they have 3 hours left. They wanted the 500-mile run the next morning, but now we can get them 100, 150 miles down the road and then get them something else. And so our miles, our utilization actually went up because now we knew for sure how many miles or hours that the driver had, and we could match that with the freight mix and the density of our network with that data.
And now I know you've developed this tech in-house. Mm-hmm. Is this something you're all developing or have developed in-house, or are there certain companies you work with?
No, we did not. I think Derek's probably been the only one that his company's really kind of done that in-house.
Yeah, Warner was the pioneer behind it, really, and then the last 4 or 5 years, the rest of us are getting on purchasing the programs.
I don't think so.
Yeah, you eventually sold to Qualcomm. Isn't that right?
Parts of the original design was sold, and over time, we continue to maintain our own and improve our own. To be fair, as we go forward, we have actually migrated to more of a industry standard system because we think that's in the best interest of our shareholders versus us continuously kind of developing our own and being on an island of one. We've migrated over the last year.
I have a question from the audience here that I'd like to interject. David, you mentioned earlier in a remark about the driver shortage and it really keeping a lid on capacity. This question has to do with the driver shortage and its impact on freight rates, both from a revenue side and a cost side. Can you comment on how the driver shortage is impacting freight rates?
Well, there's no doubt that less capacity is good for the ones that are in business. So tight capacity is good for us that are in business. It's not good when you got 100 open trucks and you're trying to find a driver. And I think that we probably all can say that we're there from that standpoint. But you know, there is some benefits to having a tight driver market, and it is in pricing, and it's in revenue per truck, and pricing drives a lot of that, and there's much more power in the rate than there is in utilization in terms of profitability. So, you know, the thing that we want to find is that equilibrium. I don't want it to get to the point where, to be honest with you, that I've got 100 extra drivers, I'm looking for a truck to put them on. I don't want that. I don't want it today, though, where I could use 200 either. And that's where we're at today, and that's where the market's at. So there's that balance, because the thing that the vast majority of us have done in this industry is we've proven over and over and over that, you know, we get greedy and dumb pretty fast. And, you know, we think it's nice. I want a bunch more white trucks running up and down the road, or blue trucks, or whatever it is. And we do some irrational things from time to time. And so it is somewhat good that we got something that's holding us back, and it's called the driver.
All right, well, let me just go through it and put it in bullet points. And let's make sure we got this right. So what we've learned today is X. Demand exceeds capacity. Not maybe by as large a margin as it did a year ago, but demand still exceeds capacity. Yes? That.
So, yes and no. Depends on Monday, Tuesday, and Wednesday, yes. Thursday and Friday, no.
that you think demand's going to continue to improve throughout the rest of the year.
Yeah.
Yes.
And that there's a real threat that capacity is going to begin to become increasingly constrained beginning in September.
Not the beginning of September.
Well, into September.
Fourth quarter.
And I think it's going to take a little time, right? I mean, I don't think you're going to flip a light switch on September 30th and it's just all going to come. I think over time it'll continue to strengthen as the clock is ticking to get those electronic logs in your trucks.
Well, it's certainly not going to increase capacity.
No, not at all. And I think it doesn't have to wait till 2 years, right? It's going to happen now, like Derek was saying, with customers saying, okay, it's time to change. The rule's done, the time's ticking, I want to connect to the right wagon.
There's something we haven't touched on yet that I want to, and that's infrastructure, and the fact that maybe the federal government has had a very hard time getting their act together to pass a long-term bill that is doing things like funding our highways. What needs to happen there? Is that having any kind of effect on your businesses right now?
Yeah, it's having a major effect. You know, we were talking about the onboard computers, and how I agree with Richard. After a couple of years, I'd rather be controlling the hours, knowing that I can get 3 more hours out of this truck, and knowing that. But it took us a couple of years to get there, right, trying to figure that out. So it is a time frame. But the opposite side of that, you know, our management will go out and ride with our drivers, and the thing that they noticed immediately is that it is horrible when a driver has 4 hours left on his or her clock on the computer at 8 o'clock at night, but at 9 o'clock at night, they're looking for a place to sleep because they know the computer's shutting off at 12, and they know if they don't find something by around 9 o'clock at night, all the truck stops and rest areas, and we look at it when we ride up and down the interstate. If you get up and ride at 6 a.m. in the morning and see what it is, the trucks are lined up and down the rest areas. There is not enough parking spots out there. So that's a major hindrance to productivity. That said, the infrastructure is horrible, and something's got to happen, and the ATA, even though, you know, I'm an advocate, I kind of gave up the ghost and said, okay, I agree. Raise fuel taxes to pay the 20th time to pay for the interstate system, because the trucking industry has paid for it every time. We pay for the infrastructure of the interstate system. Let's do it one more time, even though behind me I'm sitting there saying, America, you don't have a revenue problem at $3.6 trillion of revenue. You got a spending problem. But they have proven to me in Washington that they're not going to do nothing about it. And so it's like, okay, we'll sacrifice, one more time, raise the rates and take it from us truckers and go build an interstate.
Yeah, it's a tremendous issue as we go forward. And we've spent a lot of time in D.C. I've testified out in D.C. this year and as well as last. We would love to see action taken on the infrastructure. To me, it's the one thing that you sure would like to believe wouldn't need to be political. If your house has failing electrical or your house has failing plumbing, you don't go around buying new curtains. And that's what we're doing every day in America right now. We're spending money on accessories, but we're not taking care of the core infrastructure of the country. And if we could do that, you could lower the cost of goods by simply decongesting these areas of the country where freight bottlenecks exist. It's been proven economically the amount of money that's being spent on drivers sitting in traffic. You know, there's an estimated 55,000 drivers wasted per year completely due to congestion, and we've got to find a way to fix it. And then you look at it and say, okay, when was the last time an industry said, tax me? I need this so badly that we would like you to tax me. And we still get told no. So we also begrudgingly have come to the table and said, yeah, let's do the fuel tax. Let's find something that makes sense, index it to the future, and get something moving. And right now, unfortunately, you know, the Senate has their version. When the House comes back, they're going to work their version. Then they're going to go to conference. But one thing that seems to be clear is most of the funding of the infrastructure proposals on the table today are one-time deals, meaning it's a one-time funding source, whether it's repatriation or any of the other opportunities being discussed, which means we're going to be right back at the table again, right back in the same issue again, and longest, most needed projects won't start because they can't be funded until conclusion because the patch is too small. So this is something that is of the utmost importance, and unfortunately, and having spent time out there, I'll just tell you, I don't want to get political here, but you know, the idea of no new taxes sounds great, but there are politicians so scared to make a decision or make a move, and they're well-intended people. They are trying in many cases to do the right thing, but they have watchdog groups hanging over their shoulder every day looking to find a way to report on any tax that they may raise. So that's something that we have to make exceptions for when the exceptions make sense. And nobody likes spending money on the electrical in their house, because you don't see it, feel it, and your neighbor comes over and your house is no cooler today than it was yesterday. Or in your plumbing, but you have to do it before you no longer have a house to have them over to. And that's kind of where we're at, and that's my opinion.
I would agree. I'd just add our voice that, you know, the infrastructure is causing driver turnover. It's causing late deliveries to customers. It's causing all this extra work and nonsense that doesn't need to happen. And again, we're for the tax, but let's make sure it goes to fix the roads. Let's not build libraries. Let's not build these other things that this money goes and gets earmarked for. Let's make sure that we pay it, fix it. We use it, we're paying for the miles we run. It's time to cut through this red tape. But you, like what you just said, Derek, that's the problem with the country, is that we're beholden to all these watchdog groups and whatever. We've got to shake ourselves of that dust and really start focusing on what really matters. The infrastructure matters. It's how we're going to grow. It's how we're going to continue to develop. It's how we're going to have innovative ideas. This infrastructure is falling apart. It's terrible, and it's got to be addressed. And here we are, all three of us up here, willing to pay more taxes to get it done, but we don't have any faith and confidence that that's going to happen.
It's a very strong statement to make, that you're willing to have taxes raised just to see that happen. The beginning of this panel, we talked about fuel efficiency and new technology around that. So does raising a gas tax end up being the long-term solution? Or if it were up to you guys in the private sector, what is the long-term solution for funding infrastructure?
So in my opinion, it comes down to this. If you use fuel tax, you 99 cents on the dollar ends up being able to go into the fund. If you use vehicle miles traveled tax, if you use various registration taxes and other things, the administration of the program can consume between 10 and 40% of the revenue. So for me, the most important thing is to start with what's the most efficient means to raise the money, where the most money actually stays in the fund and doesn't go to overhead. Once you decide that, then you ask yourself, what are the fallacies with the program? One of which is MPG is going to get better, so we got to factor that in. That's why you index. You know that there's going to be certain advancements that are going to be made. You got to neutralize across fuels for their energy content, not for their gallon, but their energy content. So CNG, LNG, diesel, electric, whatever, for their energy content, find a way to tax that. It won't be perfect. but it's a hell of a lot better than doing nothing.
It'll be 80%
and continuing to wait for some perfect plan that isn't coming.
Don't let the perfect be the enemy of the good enough.
Yeah,
That's right.
80% and go.
All right.
And the next step would be to make sure the actual money collected is
Used for what it's intended for. That's a critical piece, and that's what Richard talked about, and I agree. If we're willing to raise the money, put it into the roads that everybody benefits from, not just the truckers.
And then you'll be happy.
I'll be happy.
happier.
Happier.
And I know the rail I mean, again, we're pro-rail. I don't want to offend anybody from the railroad industry, but their counter is always, are you really paying your fair share? And we don't use the roads at all, and we use the rail network. But the last time I checked, that was the single largest land grant in American history to create that rail system. So everybody has participated with their hand out at some point or another.
In one way or the other.
Donald, unless you have a final question, because we are getting near the time, I have one from the audience. It was the first text question that actually came in, and I promised that I would ask it at some point. And I think with a lot of small fleets and owner-operators in the audience, this is a perfect opportunity to ask it. As a startup trucking company, what is the best thing to do to position yourself ahead of the curve, and how can we position ourselves to remain in the game long term? So I guess advice to small fleets and owner-operators.
You know, if I was starting or was a small fleet, because I think it's where we get lost as I go back 30 years of Jacqueline and I starting with 25 trucks. I think the number one thing to do is have a top-notch accountant. I mean, that may sound elementary, but I'm going to tell you, the first thing Donald said at the very beginning, he says everybody up here can quote tire cost, insurance cost by the, cents per mile. And that is critical. And I don't know how many, whether it's trucking or any other businesses, a small carrier that has gone out of business because they don't know their cost. And I don't care if you're small enough and you can't afford a full-time accountant, go out and hire an outside accountant that's every month is going to go over your books with you and get very elementary line item by line item on the P&L statement, because if you don't know your cost, you will end up going out of business. And so that said, I do think that the small carrier, there's always going to be a niche for them. I mean, we're one of the largest niche carriers there is. We're not you call and we'll haul it. We are you call and let me ask some questions, and then we'll start hauling it. So that's what we do. So we're very similar to the small carriers that are in there, that there's always going to be a niche. And the thing that these small carriers do is that if we as a large carrier can duplicate their total piece of service, and that's what we try to do. I mean, the owner is washing the truck and changing the oil and dispatching the truck and staying up 24 hours a day and his wife is doing the accounting work and the payroll, and you're involved in that, and that is so impressive that none of us are there. There's stuff that I don't get involved in, and to make sure that you continue that, to have those customers that are paying you a fair share, know the P&L, make sure that you're getting a fair margin. As I think about exposure in our industry, I mean, I sit here and I think about every day. I mean, I'll wear the cell phone waiting on the fatality accident. I mean, that none of us won't, but we're in a business that it happens in. To sit there and say, I just had a fatality accident, my fault or the fault of the other person, but I took their life, or they took one of my driver's life. And then after you get over that emotion, to say, and we're one of the best with a 10% margin, the exposure is much greater than what the margins should be running in this industry. So to know your costs, give the great service, keep doing what you're doing. You're going to have to be able to go into onboard computers like we've been talking about, but if you're giving that great service, you can do it. You'll know your cost, and you'll know what you got to do to make sure you stay in business, either lower your cost or increase your revenue, and that's what you'll do. That'd be the advice I would give.
Okay, 2 minutes left. Derek or Richard, any advice?
Yeah, I got a plane to catch. So I would just tell you that don't be an also-ran. Pay the price to be great. To sustain superior performance, to have a winning culture, really to have customer loyalty, the drivers and the shippers, and really understand that it takes three things. It takes great people / effective people. It takes great execution and focus, and it really takes great leadership. Focus on your purpose, Make sure you know what job that is. Make sure everybody in the company understands the strategies, and have them give you the building blocks of your money-making model. If they understand that, they'll make better decisions, like you're saying, on the front line, to where you not always have to be there. So that's what I would say.
All I would add is, focus on your specific strengths that only you have if you're a small carrier. You have the opportunity to know every one of your drivers by name. You have the opportunity to know every one of your customers and see them on a regular basis and build sustainable long-term relationships. You have the opportunity to have a personal effect on everybody in your company. We try to do it with culture. You try to build a culture and you hope it trickles down. You try to meet and talk to enough drivers to hopefully that all drivers get a sense of what you stand for. You have the opportunity to do it personally. That's a competitive advantage. I would leverage it every day, and I wouldn't back down from big carriers. I would take what makes me special and maximize it and put it on display for everybody in my company every day.
Well said. Great advice from all of you. Donald, any final comments? Or
I just want to thank you gentlemen for your time, your expertise. 100+ years of trucking experience sitting here between me and Morgan, and you shared with us generously. And I want to thank you for doing so today, and thanks CCJ for putting this together.
Yeah, thank you, gentlemen, and thank you to Morgan and Donald, who really put all the content together, made it a successful event. Thank you, guys.